Now, it seems like the results are starting to trickle in. We did have results coming out from housing finance. We had that stock ending in negative territory in today's trading session. Just to look at the results, we had a 3% drop in pre-tax profit for the first 9 months of this year, really hurt by bad loans. Did you expect that kind of outcome from housing finance?
Well, the half years were not that great either. But apart from, I think the biggest problem for this year will be their cost of funds, which of course they've tried to mitigate that by issuing a bond, probably show up in the balance sheet and probably in the income statement, help mitigate some of the interest rate or rather high financing from other sources of funding in the fourth quarter. But other than the bad loans, the high interest rates, I mean, their cost of funds has been a big problem for them. So for much of this year, the issue has been difficult for them. But going to fourth quarter, the bonds should kick in and help them reduce their cost of funding.
And looking at a company like Olympia Capital, also out with results, we saw a 13% increase in the 6 months. There we had that stock ending up 7% in yesterday's trading session. So how was the market reaction to these numbers?
Well, Olympia Capital is largely a very illiquid stock. Probably hasn't tickled many investors' fancies at this point, given the many years of disappointing results. But the turnaround is welcome. I'm sure the investors who wish to pick bargain hunters for that matter will be excited by the prospect of the turnaround and perhaps a brighter future for the stock, because a turnaround could mean significant gains for investors.
And if we move on to the fixed income market, we have the 182-day Treasury bill being auctioned in tomorrow's trading session. That's worth 3 billion shillings. At the last auction, we saw a rate of about 10.76% coming through. Are you seeing further gains to this rate going forward?
Yes, the trend has been upwards in the fixed income segment, especially in the T-bill rates, simply because you know, everybody is very aware of government financing problems. So nobody wants to. Everybody is charging a premium over and above what the previous you know, rate close. Simply until that the time, such a time where everybody thinks that the government's finances are beginning to look sustainable. But for now, I think everybody will be looking to increase their rates, which will mean that the next auction also will end up with higher rates, probably approaching 11% on the 182. 91 probably cross over to 10%, probably by 20-30 basis points. So just so that you can protect yourself from expected higher, even higher rates in future.
And Johnson, looking at the money supply growth, we saw it slowing in September, coming in at 12.5% from 14%, with some really saying that this declining trend in money supply could perhaps give the central bank more room to cut interest rates. Is that the thought that you're sharing right now?
No, in recent times, you've seen the government come under pressure from IMF that money supply is growing too fast. And that of course then means they should tighten it. The prospect of inflation is still looms large. I don't think that has largely been solved. We also have another problem of currency weakness, which is somewhat related, but a dynamic that could give the central bank governor a headache, given that we have some foreign currency denominated loans. So they were not out of the woods yet. We still have to watch our exchange rates, and for that matter, that alone could probably cause the governor to, you know, shrink money supply. And with the pressure from IMF as well, same result expected. So for us, we're expecting high interest rates as a result of tight money supply, low interest rates currently notwithstanding.